A dividend feels like free money hitting your account, but is it actually making you richer, or is it just changing the shape of your return? When you invest in a stock or fund, your money can show up in two main ways. One is cash paid to you, often as a dividend. The other is growth in the price of what you own. Together, those two parts are called total return. Total return asks one simple question. After everything is counted, how much more or less wealth do you have than when you started? It does not care whether the return arrived as cash, a higher share price, or a mix of both. This matters because investors often focus on income they can see. A dividend payment is visible. A price increase can feel less real until you sell. But from a wealth perspective, both can increase what you own, and both deserve attention. Think of an investment like an apple tree. Dividends are like apples picked from the tree and handed to you. Capital gains are like the tree itself becoming more valuable. A healthy orchard can matter more than a big basket of apples today. A dividend is a cash distribution from a company to shareholders. Companies usually pay it from profits or available cash. When you receive a dividend, you now have more cash, but the company has less cash than it had before paying it out. This is why dividends are not magic. All else equal, when a company pays cash out, the value of the company is reduced by that cash leaving. In real markets, prices move for many reasons, but the basic logic still matters. Imagine a stock worth $100. It pays a $4 dividend. You receive $4 in cash. If nothing else changed, the stock would be worth about $4 less because that cash is no longer inside the company. This does not mean dividends are bad. It means they are not a bonus on top of everything else. A dividend is one way your investment value is delivered to you. The key question is what happens to your total wealth after the distribution. Capital gains happen when the market value of your investment rises. If you bought a share for $100 and later it is worth $120, you have a $20 gain. If you sell, that gain becomes realized cash. Some people trust dividends more because gains can disappear before you sell. That risk is real, but unrealized gains are still part of your current wealth. Your house, your business, and your investments can all gain value before you sell them. If this kind of clear money explanation is useful, consider subscribing. The goal here is not to hype one strategy. It is to understand the mechanics so investing choices feel less confusing and more deliberate. Dividend investing usually means choosing companies or funds that pay regular cash distributions. Some investors like this because it can create a stream of income without selling shares. That can be emotionally comfortable, especially for people living off a portfolio. There is a real psychological benefit to receiving cash. It can feel disciplined and steady. Instead of deciding when to sell, the investor receives payments automatically. For some people, that structure helps them stay invested through market ups and downs. Total return investing looks at the whole outcome. A total return investor may own dividend stocks, growth stocks, bonds, index funds, or a mix. The focus is not whether cash arrives every quarter. The focus is how the entire portfolio grows and supports future spending. One misunderstanding is that selling shares for cash is always worse than receiving dividends. But selling a small portion of an appreciated investment can be another way to create cash flow. It is not automatically better or worse. It depends on the bigger picture. Picture two investors starting with $10,000. One owns a fund that pays income. The other owns a fund that keeps more earnings inside and grows in price. If both produce the same total return before taxes and costs, the investors may end up with similar wealth. Suppose investment A pays 4% in dividends and rises 4% in price. Suppose investment B pays no dividend and rises 8% in price. Before taxes and costs, both have produced an 8% total return. The income looked different, but the total result matched. A high dividend yield can look attractive, but yield alone does not tell you whether an investment is healthy. A stock can have a high yield because the dividend is large, or because the share price has fallen sharply. Those are very different situations. Sometimes investors chase the biggest yield and ignore the business behind it. If a company cannot support its dividend, it may cut the payment. When that happens, the investor may lose income and may also see the share price fall. High income does not guarantee high wealth. A dividend is stronger when it comes from a business with durable cash flow, manageable debt, and a payout level it can afford. The point is not just how much is paid today. The point is whether the company can keep creating value over time. Many dividend investors reinvest their dividends. That means the cash payment is used to buy more shares. Reinvestment can compound over time because future dividends and future gains may be earned on a larger number of shares. Compounding is often associated with dividends, but it is not limited to dividends. A company that reinvests profits wisely inside the business can also compound value. A fund that grows in price can compound too. The engine is return on capital, not the label on the return. A company can use profits in several ways. It can pay dividends, buy back shares, reduce debt, make acquisitions, or invest in new projects. The best choice depends on the opportunities available and how effectively management uses money. Dividends can be useful for investors who want regular cash flow. They can also encourage discipline by reducing the need to decide which shares to sell. For some people, that simplicity has value, even if it is not the only rational way to invest. A total return approach can be useful when the goal is long-term wealth growth or flexible withdrawals. It allows the investor to compare investments more fairly. Instead of asking which one pays more cash today, the investor asks which one improves the full portfolio outcome. Taxes can make the comparison more complicated. Dividends may be taxable when paid, even if you reinvest them. Capital gains may not be taxed until you sell. The details depend on account type, tax law, holding period, and the investor's situation. The same investment can feel different in different accounts. In a taxable account, the timing and type of income can matter. In a retirement account, taxes may work differently. This is one reason personal context matters more than a simple slogan. A dividend does not remove risk. A dividend stock can fall in price. A dividend can be reduced. A high-income fund can still lose value. The fact that cash is being distributed does not mean the underlying investment is safe. Imagine receiving $500 in dividends while your investment value falls by $2,000. The cash felt good, but your total wealth still declined. Looking only at income can hide what is happening to the whole account. The opposite mistake can happen too. A portfolio with strong growth but no cash payments may still need a withdrawal plan. If an investor needs spending money, they must decide when and how much to sell. Total return gives the big picture, but cash flow planning still matters. For someone building wealth, reinvesting may be the priority. For someone living from a portfolio, reliable cash flow may feel more important. But in both cases, the central question is the same. Can the portfolio support the investor's goals without taking more risk than they can handle? Some investors prefer dividends because they like the routine. Others prefer total return because they want flexibility. A preference is fine. The problem begins when someone assumes their preferred form of return is automatically superior in every situation. A fair comparison starts with total return, risk, fees, taxes, diversification, and whether the strategy fits the investor's behavior. Dividend yield is only one number. It should not be treated like a complete report card for an investment. Dividend investing is not wrong, and total return investing is not a trick. They are different ways to think about how investment value reaches you. Dividends turn some value into cash along the way. Total return asks whether your whole pile of wealth is growing after everything is counted. The best approach is not the one with the most exciting label. It is the one you understand, can stick with, and can evaluate honestly. If dividends help you stay disciplined, understand the trade-offs. If total return gives you flexibility, have a cash flow plan. Now I want to hear from you. Do you find dividend income more motivating, or do you prefer focusing on total return? Leave a comment with your questions and tell me what money topic you want explained next.